Hello everyone, welcome back to Financial Path. Imagine this, America is $37 trillion in debt. That's trillion with a T. And here's the kicker, our interest payments on that debt are now bigger than our entire military budget. It's like paying more on your credit card interest than on your mortgage and groceries combined. President Trump says enough is enough. He wants to slash interest rates fast to save what he calls hundreds of billions of dollars. But the Federal Reserve, led by Jerome Powell, is holding the line. So why the standoff? Why is the Fed saying no when Trump is shouting yes? Let's dive into the high-stakes battle that could shape the future of the U.S. economy. Trump versus the Fed. Since stepping back into the Oval Office on January 20, 2025, President Trump has wasted no time making waves in policy and public pressure, and his latest campaign isn't aimed at voters, but at the Federal Reserve. His message is blunt: cut interest rates immediately. Why the urgency? Because America's debt problem isn't just big, it's exploding. According to the U.S. Treasury fiscal data, the U.S. national debt reached $36.22 trillion in June 2025. The debt continues to grow, with a 31% increase since 2019 and a 2% increase from May 2024. The cost to service that debt is ballooning and expensive, with $776 billion spent to maintain the debt in May 2025. In fact, from the fiscal 2024 spending diagram, we can see that the government is now spending more on interest payments of $882 billion than on national defense of $874 billion. At the same time, Treasury data also shows that interest payments this fiscal year have jumped over 10% compared to the same time last year. Trump argues that just a 1% cut in interest rates could save the government around $300 billion annually. Push that to 2.5%. And the savings would soar to $600 billion. He said, "We could save hundreds of billions just by making one smart move. And if inflation pops back up, no problem," he says. "Just raise the rates again, simple." To Trump, it's common sense. To the Fed, it's risky. While Trump sees urgency and opportunity, the Federal Reserve sees something else entirely, and they're not rushing to follow his lead. Unlike the White House, the Federal Reserve doesn't act on political pressure, or at least it's not supposed to. Its job is to serve the economy's long-term health, not short-term budget relief. That's why it operates under a dual mandate given by Congress: promote maximum employment and keep inflation stable, ideally around 2%. Fed Chair Jerome Powell made it clear, "What we want is a good, solid American economy with a strong labor market and price stability. That's what matters to us. Pretty much that's all that matters to us." So, why is the Fed holding interest rates steady when Trump is demanding urgent cuts? Here's the current situation. The labor market is still in decent shape, with unemployment at 4.2%, job creation, and layoffs in equilibrium. But the Fed's projections in June 2025 show it could climb to 4.5% by the end of the year, a potential red flag. At the same time, inflation is ticking up. In the June 2025 FOMC meeting, the Fed expects PCE inflation to hit 3.0% and core inflation to reach 3.1% by the end of 2025, both well above their 2% goal. And what will be the major culprit behind rising prices? Tariffs, many of which come directly from Trump's trade policies. Powell warns that businesses are just starting to pass those costs on to consumers. As summer rolls on, inflation is likely to spread. That's why Powell is in no hurry. Cutting rates too soon could unleash inflation all over again. He said, "We have to be forward-looking, but acting now without clarity could backfire." So where the real tension begins, it is not a disagreement about numbers, it's a fundamental clash of missions. The Federal Reserve and the President of the United States are both powerful, but they answer to very different responsibilities. The Fed operates as an independent body. It doesn't follow political agendas. Its job is to look at the big picture, keeping inflation low and jobs plentiful. Every interest rate decision they make is meant to protect the long-term health of the entire economy, not just next quarter's budget. But President Trump is different. He's running the day-to-day operations of the federal government, and he's staring down a mountain of costs. His administration has made it a mission to cut waste, streamline operations, and save America money. One of his boldest moves was passing what he called the One Big Beautiful Bill, a sweeping tax cut that stimulated short-term growth but sent the national debt soaring. To fund that tax plan and reduce operational costs, Trump has been trimming federal departments and cutting government programs. But even with those efforts, the biggest weight around his budget's neck is the rising cost of interest payments on U.S. debt. From Trump's perspective, cutting interest rates isn't just smart, it's necessary. It would instantly lower the cost of borrowing, free up billions in the federal budget, and make his fiscal vision more achievable. But the Fed? It doesn't exist to ease the Treasury's debt burden. It exists to stabilize the entire economy in the longer term. That's the core of this collision. President Trump's aggressive trade policies have added a complicated twist to the Fed's decision-making. His 10% blanket tariff on almost all imports was designed to protect American industries, but it's put the Federal Reserve in a tough spot. Tariffs can act like a double-edged sword. On one hand, they reduce imports and support domestic production. That sounds good, right? But here's the flip side. They also raise the cost of goods. That extra cost trickles down the supply chain until it lands squarely on the shoulders of American consumers. Fed Chair Jerome Powell has pointed out that many of the goods on store shelves up to June 2025 were imported months ago, before the tariffs were imposed in April 2025. But that's about to change. We've had goods inflation just moving up a bit, Powell warned, and we expect to see more impacts of the tariff over the course of the summer. This puts the Fed in a tricky position. If they cut interest rates too soon, just as these tariffs start driving prices higher, they risk unleashing a new wave of inflation. That could force them to slam the brakes and hike rates again, sending mixed signals to the market and potentially hurting economic confidence. So Powell's dilemma is this: wait, watch, and gather more data, or act now and risk setting off the very inflation they're trying to avoid. However, with a stable labor market and a still strong economy, the best thing Powell should do is to wait before the tariff element becomes more certain to keep the stable national economy. If there's one thing Trump doesn't do, it's stay quiet when he's frustrated. And when it comes to the Fed, he's been anything but silent. Over the past few months, Trump has launched a full-blown public pressure campaign against Jerome Powell, the Fed chair he once appointed. From speeches to social media, Trump has called Powell everything from Mr. Too Late to one of the dumbest, most destructive people in government. He's even joked, half seriously, about appointing himself to the Fed to get the cuts he wants.
I call him Too Late Powell because he's always too late. I mean, if you look at him, every time I did this, I was right 100%. He was wrong. Maybe I should go to the Fed. Am I allowed to appoint myself, Doug? I don't know. Am I allowed to appoint myself at the Fed? I do a much better job than these people.
Trump's message is clear. Europe has had 10 cuts. We've had none. We're being left behind. Whether it's through humor, sarcasm, or public jabs, his strategy is to push, prod, and pressure the Fed into action. But so far, the Fed hasn't flinched. Powell has stood firm, emphasizing that the central bank must operate independently. He repeatedly emphasized, "Our policy is well positioned right now to deliver price stability and a strong labor market. That's what matters to us." Economists are watching this closely. Many warn that if the Fed ever caves to political pressure, no matter who's in the White House, it could shatter the very trust that underpins America's financial credibility around the world. For all its tough talk and cautious tone, the Fed isn't entirely unified. In fact, subtle cracks are beginning to show in its wait-and-see approach. Fed Governor Christopher Waller, who was appointed during Trump's first term, has made it clear, waiting until the economy starts breaking down is the wrong move. He believes the Fed should consider a rate cut now, before layoffs surge or consumer spending collapses. He argues, why wait for a crisis when you can act early to prevent one? Echoing that sentiment, Vice Chair Michelle Bowman recently said that if inflation pressures remain contained, she would support cutting rates as early as our next meeting. Even Powell, while still cautious, has left the door slightly ajar. If inflation slows more convincingly, or if the true impact of tariffs becomes clearer, he admits the Fed could pivot and begin easing sooner than markets expect. So while the Fed remains cautious, the internal debate is heating up, and that may signal a shift is coming. At the June FOMC meeting, the Fed signaled it expects to cut rates twice this year, likely 2 quarter-point cuts, bringing the federal funds rate down to around 3.9% by year-end. But that's still a far cry from the 2.5% immediate cut Trump is demanding. So what would push the Fed to move faster? A weakening labor market. If unemployment starts to climb significantly, or if job creation sharply slows, that could force the Fed's hand. Until then, Powell is sticking to his cautious stance. He's keeping an eye on more than just inflation and jobs. He's also watching how Trump's tariffs evolve and whether rising tensions in places like the Middle East shake global markets. For now, the message is clear. Wait, watch, and don't blink too soon. At its core, this isn't just a debate over interest rates. It's a deeper conflict of purpose. President Trump wants quick action to cut costs, reduce debt burdens, and push his agenda forward. The Fed, on the other hand, is focused on protecting the broader economy, carefully balancing inflation, employment, and long-term growth. Both are looking at the same economic landscape, but through very different lenses. One is urgent and political. The other is deliberate and data-driven. And until one side yields, or reality forces a shift, this standoff between politics and policy is far from over. What do you think? Should the Fed hold steady, or should Trump's urgency take the lead? Comment below with your take, and don't forget to subscribe to my channel to support me for a continuous deep dive. Thanks for watching. See you in the next one.